All right, let's dive right in. Today, we're tackling one of the most important investing books ever written, The Intelligent Investor by the one and only Benjamin Graham. Our goal here is pretty simple: to break down the core wisdom of this absolute masterpiece. And you'll see these principles are just as powerful today as they were way back in 1949. This isn't just about how to pick stocks, it's a whole philosophy for how to think about the market with a clear head. So to really get why Graham's ideas are so vital, we have to go back in time to the dot-com bubble. This quote right here, from the year 2000, just perfectly captures the feeling in the air. This idea that a stock's price could actually be too high, people thought that was just old-fashioned, a silly mistake. It was a time of just incredible, dangerous confidence, where everyone was saying the old rules were dead. This was a new world order where profits and fundamentals, they just didn't seem to matter at all. And you know, that kind of unbreakable confidence, it led to some real madness. So in our first section, let's explore this frenzy. We'll look at a time when Wall Street was practically giving away so-called sure things that, well, turned out to be anything but. I mean, financial TV, the early internet, it all turned the stock market into this non-stop show, like a giant video game for the whole country. I remember this one Ameritrade ad. It had a housewife who, after a quick jog, logs on, clicks her mouse a couple of times, and yells, "I think I just made about $1,700. Trading was sold as this easy, thoughtless thing you could do between errands. Stocks stopped being businesses. They were just little blips on a screen. And as long as those blips kept going up, nobody seemed to care about anything else." This quote, man, it just perfectly shows the kind of thinking that was going on. This wasn't about looking at a company's finances or trying to understand its business. Nope. People were making huge decisions based on gut feelings, on superstitions, and, in this case, even their astrological sign. This is literally the polar opposite of the thorough analysis that Benjamin Graham preached, was the absolute foundation of smart investing. And all this emotional chaos led to some numbers that are they're truly hard to wrap your head around. Take a company called VA Linux, a classic dot-com stock. On its very first day of trading, this was December 9th, 1999, its stock price just exploded. It gained an unbelievable 697.5% in one day. People were practically fighting each other to buy shares in a company that had proven almost nothing, and suddenly it was worth nearly $10 billion. It really felt like the party was never going to end. But yeah, the party did end, and it ended hard. This chart right here just shows you exactly what happens when hype gets totally disconnected from reality. After peaking at almost $240 on day one, VA Linux came crashing right back down to earth. The market woke up and realized the valuation was just built on hot air. And exactly 3 years later, that same stock was trading for $1.19. The rocket ship had turned into a rock. So, and this is so important, once you lose 95% of your money, you have to gain a mind-boggling 1,900% just to get back to where you started. Think about that. One single foolish risk can dig you a hole so deep that it's almost impossible to ever climb out. And this right here, this is the exact problem that Graham's entire philosophy is built to prevent. So how do you avoid a catastrophe like that? To find the answer, we've got to meet the man who designed the solution, Benjamin Graham, who is known today as the father of value investing. Now, Graham wasn't some academic just writing theories from an ivory tower. No way. His principles were forged in the fire of real life. After his dad died, his family was plunged into poverty. He had to start at the very bottom on Wall Street as a clerk. And then, during the great crash of 1929, he felt that pain of devastating loss himself, losing almost 70% of his money. So his wisdom wasn't just theoretical, it was earned the hard way. It was from these painful lessons that he came up with the timeless rules in his book. And the absolute cornerstone of his whole philosophy, the idea that everything else is built on, is this one crucial distinction. It's the difference between being an investor and being a speculator. Okay, this is Graham's own definition, and believe me, every single word here counts.
Thorough analysis means you actually do the homework. You understand the business, how it works, what its finances look like, what its future might be. Safety of principle is the foundation. It means your number one priority is not losing the money you started with. And an adequate return means you're not trying to get rich overnight. You're just aiming for a satisfying, reasonable profit. Anything that doesn't check all three of those boxes, in Graham's world, is not an investment. It's a gamble, it's speculation.
So let's really break that down. The investor asks, what is this actual business worth? But the speculator asks, what's the stock price going to do next week? See the difference? The investor is playing the long game, like they're owning a piece of a business, and they're focused on its real value and protecting themselves from losses. The speculator, they're playing a short game. It's like betting at the racetrack. They're just trying to guess what the crowd is going to do next, and all they can think about is that quick profit. They might both be buying stocks, but they are playing two completely different games.
To help us stay in that investor mindset, Graham came up with this brilliant little story, an allegory. It's a way to think about how irrational the market is without getting sucked into the chaos yourself. So it's time to meet Mr. Market. Graham asks you to picture this. Imagine you're in business with a partner. His name is Mr. Market, and every single day without fail, he shows up at your door. He's a very agreeable guy. He's always willing to either buy your share of the business or sell you his, and he always gives you a price. But here's the catch. Your partner is, well, he's a manic depressive. Some days he shows up absolutely euphoric, screaming about how amazing the future is, and he'll offer you a ridiculously high price for your shares. But other days, he's just drowning in pessimism, convinced the world is ending, and he'll offer to sell you his shares for almost nothing. The key thing to realize is that his prices are driven by pure emotion, not by the actual stable reality of the business you own together. And this is the secret to dealing with Mr. Market. You don't have to listen to him. You're never forced to trade with him, ever. When he shows up terrified, offering to sell you his shares at a huge discount, you can calmly decide to buy. And when he's giddy with excitement and offers you a crazy price for your stake, you can happily sell to him. And on all the other days when his prices are just nonsense, you can just shut the door and go about your business. His mood becomes your opportunity, not your instruction. You turn him from your master into your servant. So if we use Mr. Market's moods to our advantage, how do we protect ourselves from our own mistakes? How do we make sure we're safe even when we're wrong? Well, that brings us to Graham's final and maybe his most important principle. The margin of safety is really the central concept of Graham's whole philosophy. It's actually pretty simple. Don't just buy good businesses, buy them for way less than what they're actually worth. So if you've done your homework and you figure a company is truly worth $1 per share, you don't buy it for 95 cents. You wait. You wait until Mr. Market is having one of his terrible, pessimistic days and offers it to you for 50 cents. That 50-cent difference, that's your margin of safety. It's like building a bridge. If the bridge needs to hold 10 tons, an engineer builds it to hold 20. That extra capacity is the margin of safety. It's your buffer against bad luck, bad timing, or just being plain wrong in your analysis. You know, Graham's most famous student, Warren Buffett, he boiled this whole idea down to its absolute essence. This isn't about chasing the biggest, flashiest returns. It's about being obsessed with avoiding permanent loss of your capital, because the math of losing money, it is brutal. This table shows you just how unforgiving that math is. Look at this. A 50% loss doesn't mean you need a 50% gain to get your money back. No, you need a 100% gain just to get back to even. A 75% loss requires a 300% gain. Big losses are exponentially harder to recover from. And that's exactly why avoiding them has to be your top priority. The margin of safety isn't just a nice idea. It's a mathematical necessity if you want to succeed in the long run.
And that brings us to the real takeaway from Graham's teaching. Look, the market is going to do what the market is going to do. Mr. Market is always going to be an emotional wreck. Stocks will go up, stocks will go down. The real risk, Graham teaches us, doesn't come from the outside world. It comes from inside of us. It's your own behavior, your own discipline, and your own character that will decide your financial fate.
So, we'll end with the one question that lies at the very heart of the intelligent investor. Is the market your master, telling you what to do and controlling your future? Or is it your servant, just there to present you with opportunities? The answer to that question will define what kind of investor you truly are. Thanks for joining me.